Welcome to LumiNational's module on loss creation in the context of startup corporations and Section 382. In this module, we will cover some basic considerations on how companies create losses and how that relates to certain key aspects of 382 planning, which is particularly relevant in the context of startup corporations. In any given tax year, a corporation can generate either income or loss. Income is generally categorized in one of two ways: ordinary income or capital gain. Likewise, loss can be categorized in one of two ways: either ordinary loss in the form of net operating loss or a capital loss. Typically, these amounts can be offset against each other in respective fashions. In other words, ordinary income can be applied against ordinary loss. And we'll talk a little bit about how that happens when we start talking about concepts of carry back and carry forward. Likewise, the capital gain can be offset by capital losses in a similar manner. An operating loss results when a corporation has insufficient revenue to cover its deductible expenses. Deductible expenses include salaries, rents, interest, depreciation, and amortization. If a corporation's deductible expenses exceed its revenues, then the corporation has generated what's known as a net operating loss for that tax year, or an NOL, as we'll reference it in this module. The amount of money received by a taxpayer on the disposition of a capital asset, together with any other consideration received, is used to measure whether or not the corporation has generated capital gain or capital loss. A capital loss results when the amount of money and other property received, call it total consideration received, is less than the adjusted tax basis in the asset disposed. A capital loss can be represented in the following equation: the amount realized less the adjusted basis equals the gain or loss realized. Generally, under Section 1001, gain or loss realized is recognized. There is an important parenthetical reference in Section 1001 of the Code which permits an exception to these general rules, but for now we'll consider the gain or loss realized to be recognized. The amount realized in this equation is essentially the consideration received. Cash, property, services, and even debt assumption is included in the definition of amount realized. The adjusted basis is essentially the after-tax investment that a taxpayer has in the property, as adjusted for things like depreciation and amortization. Switching gears a bit, a corporation cannot lose money or property unless it has money or property to lose. The question is, how does a corporation get such money or property to lose? And that's, of course, through either one of three sources: either from initial equity investment or periodic equity investment through various rounds of financing, through historic profitability, or through debt financing and the funds that result from a borrowing. A corporation can generate loss from spending, essentially, its historic profitability. How does that happen? A corporation can generate profitability and wealth over time to the extent it develops sales or has services that it's generating revenue for. That profitability over time can theoretically later be spent on new investments or on expansion or on other things to grow the business. And in that way, a corporation's ability to generate loss from historic profits is limited to the historic profitability of the company. Cash spent from profits can produce a net operating loss to the extent the corporation spends that cash on things like ordinary and necessary deductions, salaries, rent, or interest. If the corporation spends the historic profits on fixed property or intellectual property, that property can result in either depreciation deductions or amortization deductions, which likewise will create the potential for a net operating loss. Let's turn to an illustration. In this illustration, assume that A shareholder owns the stock of X corporation represented by this rectangular box. X corporation generates $100 of income a year for 10 years. This would result in a total income of $1,000 over a 10-year period. This $1,000 would then, assume in this example, be spent in year 11. If there's no other revenue, X corporation would generate a net operating loss of $1,000 in this example. This $1,000 net operating loss would be subject to a carryback period and a carry forward period. In this example, we would carry that $1,000 loss back 2 years and apply it against the $100 generated in 2009 and again against the $100 generated in 2010, resulting in the potential for a refund of taxes paid for those 2 years. The remaining $800 would then be net operating loss carry forward, which would be brought forward for a period of time. We'll discuss the carry forward and the carry back provisions shortly. Cash from capitalization can result in loss creation to the extent the cash that is raised through the capitalization event is spent on depreciable or deductible items. Cash from capitalization can come from two sources, either from equity funding or from debt funding. A corporation in startup mode typically cannot obtain debt financing. Debt financings, as mentioned, are available for corporations that have established a track record with respect to either revenue generation, profitability, or asset creation. In a startup context, a corporation has not yet demonstrated its ability to establish a strong reputation in any one of those areas, typically. Therefore, in startup mode, corporations often seek equity infusions from shareholders, either existing or through the issuance of various rounds of financings, of fundings. So a corporation in startup mode will often have various series of equity issuances that it offers to the public or to its shareholders in exchange for cash to fund operations. Equity capitalization typically represents an important financing source for a corporation's ability to grow and develop new products. Likewise, the equity infusion that a corporation gets through various rounds of capitalization through equity issuances can represent a significant source of future loss generating capacity. In other words, a corporation that has received equity infusion has now capital to dispose of. It can invest in property, people, or markets, development of new markets either domestically or abroad. In this next illustration, we see how a corporation's ability to generate loss from a capital infusion is what we'll say supercharged as it's compared to the prior illustration where the corporation generated loss from historic profitability. In this illustration, we assume that A owns X corporation and in year one contributes $100 to the equity of X corporation to fund its very initial expenses. In that year, X corporation spends the $100 and creates an expense that results in a net operating loss in the amount of $100. If in year two, another shareholder, B, comes in and invests $10,000, X's loss generating capacity increases dramatically and theoretically can produce a much greater loss. Couple of observations. When comparing this example to the prior illustration, we see that the loss generating capacity is not limited to the profitability or the cash generating potential of this enterprise. It has nothing to do with that. Instead, the loss generating capacity is a function of how well it can raise equity in the capital markets. And in this way, the loss generating capacity of X corporation can be supercharged. The second observation is that a shareholder coming into the corporation may represent a fundamental shift in the direction of the corporation from a governance perspective, from an ownership control perspective, and as we'll see later, from a 3D2 or loss limiting perspective. This is an important shift that the IRS recognizes as potentially meaningful to the corporation's ability to utilize historic losses. The third observation is that a corporation's ability to generate future losses is, of course, then limited on its ability to access additional capital in the capital markets. It's important to note that to the extent a company obtains equity financing through various rounds of equity issuances, the equity issuances are typically subject to prevailing market conditions. The prevailing market conditions can affect the pricing of an issuance, for example, a Series A, B, or C issuance. And of course, a number of factors go into the pricing, but it's important to note that the issuances are subject to not only the performance capability of the corporation, but also of prevailing market pricing. Also, to the extent a corporation accesses capital through equity markets, it will have series of issuances, a series of issuances that may have participation by historic shareholders or may not. To the extent historic shareholders do not participate in subsequent rounds of equity issuances by a corporation, then those shareholders' ownership would theoretically dilute over time, and the subsequent equity issuances may result in an owner shift, which is an important consideration for purposes of Section 3D2, the provision that governs the corporation's ability to utilize losses against future profitability. Let's discuss the concept of loss carryover. Loss carryover is essentially Congress's way of softening the impact of a loss that a corporation experiences for a variety of reasons, but including economic cyclicality of various business operations. If a corporation experiences a loss in a given year, Congress has given it the ability to carry that loss back and apply it against historic profitability to the extent it has any, or forward and apply it against future profitability. And so in that respect, a loss that is generated in one tax year is subject to carry over, meaning carry back or carry forward. In the case of an ordinary loss, the carry back period is 2 years. So the year that the loss is generated can be applied against the 2 preceding tax years. Thereafter, it's carried forward for a period of 20 years and applied against future profitability. Likewise, a capital loss is subject to carry back and carry forward. A capital loss is able to be carried back 3 years and forward only 5 years. To the extent the corporation generates capital gain, then that capital loss can be utilized. To the extent the corporation does not generate capital gain, then the capital loss may go unused and expire. As part of the American Recovery and Reinvestment Act of 2009, a corporation that experienced a loss in either 2008 or 2009 could take that loss back 5 years. So that represented an important exception for losses generated in either 2008 or 2009. So what is a loss in the hands of a corporation? A loss is a measure of the investment that a corporation has made in either its operations or its products. The corporation has this loss as a tax asset or a tax attribute. In other words, it's a property of the corporation and it survives as long as the corporation survives. Since both losses, ordinary and necessary, are attributes of the corporation, to the extent the corporation's stock changes hands, those attributes may nevertheless survive. Where stock of a corporation is transferred from one shareholder to another, the purchasing shareholder may inherit the tax attributes of the corporation by virtue of owning the stock of the corporation. Remember that the tax attributes, in this case a loss, survive a transfer at the shareholder level. Let's consider an illustration. In this illustration, X Corporation has an accumulated net operating loss carry forward of $1,000. If A shareholder transfers the stock of X Corporation to Y in exchange for cash, Y Corporation will theoretically inherit the net operating loss. Disregarding Section 382 for a moment, if Y is a corporate parent of a consolidated group or a member of a consolidated group, this loss that X brings into the Y group may represent an after-tax cash savings. This assumes that Y is profitable, and secondly, assumes a rate of 35%. If a rate of 35% is applied to the $1,000 of loss that Y can utilize, that represents $350 worth of after-tax cash savings that Y can generate. Of course, Section 382 may apply and may present a limitation on Y's ability to utilize X's loss. Section 382 attempts to regulate the amount of corporate loss carry forward. Section 382 always applies to loss carry forward and never applies to loss carry back. Let's look at an illustration. In this diagram, the corporation X has both ordinary loss and capital loss. As previously mentioned, an ordinary loss is subject to a 2-year carryback. Likewise, a capital loss is subject to a carryback 3 years in this instance. If a corporation has either ordinary loss or capital loss that it carries back, that carryback is consumed and cannot be transferred. Section 382 applies only to the portion of loss that is carried forward and may limit that loss to the extent the stock of X corporation experiences an ownership change. Let's take a moment to recap. A corporation cannot lose money or property unless it has money or property to lose. A corporation can lose money or property from one of 3 sources: historic profitability, from equity capitalization, or from borrowed cash. A corporation's ability to generate loss is greatly enhanced to the extent it uses cash raised either from equity or debt capitalizations. Losses, ordinary, can be carried back 2 years and carried forward 20 years. Capital losses can be carried back 3 years and forward 5. A corporation's losses are tax attributes of the corporation and are transferable to the extent the stock of the company is transferred. Equity issuances are subject to market conditions and often follow the direction of broader market trends. Section 382 applies only to loss carry forward. Let's turn our attention to Section 382 and discuss some of the basic elements of 382 and how they relate to startup companies, and discuss some examples and illustrations in that context.